start the day at midnight, New York local time. That's the beginning of the new day. What does the London session do between 2 o'clock and 5 o'clock in the morning? All right, between 2 o'clock and 5 o'clock in the morning, that is the London Open Kill Zone. Why is that thing taking? So from 2 o'clock to 5 o'clock in the morning, what's the market do? It drops. This here is a Judas swing. A Judas swing is a fake price run for the express purposes of taking traders out of potentially profitable traders, position being long in this case, or to put them into the opposite direction, because there's always going to be traders out there that trade a breakout. I'm not a breakout trader. We'll talk about breakaway gaps today too, by the way. The idea of focusing on a bias that is bullish on the daily chart, weekly chart, monthly chart, we're expecting higher prices. We're not resisting the likelihood of higher prices and a new all-time high on NASDAQ. So because of that, in my mind, I want to see what price does between midnight going down into 2 o'clock. Is price dropping? Yes. Is it dropping to some random level? No. Look over here. Below that low is going to be what? Sell stops. So traders that see this low and break below that and it's consolidating, someone's going long there. I don't need to know who it is. There's always going to be buyers and sellers, always. But that buyer or seller pressure is not what causes the markets to go higher or lower. The markets are absolutely rigged. They're engineered to go higher or lower, because whatever the market is in fact trying to reach for, buyers or sellers, they're not pushing it there. The market's going to go to where the liquidity is, and it will keep repricing until it gets there, because it's a game that's controlled by them, quote unquote. Okay. So if we're bullish and we see that they did in fact take out traders that had stops below here at a time of day when it creates the high or low of the day, not all the time, not all the time, most time, between 2 o'clock and 5 o'clock in the morning, London will create the high or low of the day, whether it be Forex, whether it be index futures, it doesn't matter. This is a truism. Now, because it does that very thing here, right at 3:30, and that's the low of the day. Now, when it creates that low, we want to see some kind of displacement to the upside, because if it does do that, that's indicating the algorithm is flashing like a billboard sign to smart money who trades on it. It's going to go up now. So focus on seeking a premium price. So what is a premium price? It's going to be a short-term high, because right above short-term highs is going to be what? Buy stops. And or a fair value gap above market price. Okay, so if we went down here, where is there a old high and where is there an imbalance? Well, between this low here to this candle here, that's an imbalance. It's a sell side imbalance, buy side inefficiency. A fair value gap that has a down close is a SIBI. First thing in my mind is, okay, how do we trade after that? And it should go into this gap here, which is being shaded. Does it do that? Absolutely it does. Then it creates what? Another gap here. This is a buy side imbalance, sell side inefficiency, because it's a fair value gap that has an up close. So while I'm looking at price action in response to this area here, I'm also now measuring the willingness to see price find more support in this fair value gap. So I'm looking at it like a rock climber would, okay? I look at this entire drop here as a rock or cliff on a rock, and I want to climb all that. I might not, but when price starts to run up in here, it goes into this area here and just comes into the high of that candle right there. So what's above that? Another gap. We'll get to that in a minute, okay? But the market rallies up and it leaves this imbalance. You start looking at it like this, I promise everything will start clicking, and it'll feel like it's illegal for you to know what you do. So this buy side imbalance, sell side inefficiency, I'm annotating the high of that candle and the low of that candle, and I'm focusing on the range between those two price points on this candle here. So when you see me putting rectangles on my chart, that's not a supply and demand zone. I'm looking at how this offered buy side imbalance. It's inefficient in the scope that it is not offered enough opportunity for people to sell. It's moved one-sidedly on this time frame, the 15-minute time frame. So I'm anticipating price to want to do what? Offer price on the downside, or offer it through sell-side delivery. This is buy-side delivery when price is expanding higher. This is sell-side delivery when it's offering price as price is dropping. Since I've seen it price drop down here, and I'm bullish longer term, I anticipate this as a stop run. I don't need to buy down here. I don't need to. I don't need to be awake. In fact, I wasn't to see this. If I was awake at the time, I would have went long in here. And then I would have pyramided in here and added more. And then I would have pyramided right there where you're going to see where I entered. This is the only trade I took today so far. So think about it. It goes down here to take the stops on a day when we're bullish. Okay, wonderful. Does the market immediately react by going higher after it goes below that low? Yes, it does. And also notice where the bodies are. See, the wicks they're trading down and past that low. That's the damage. See where the close of this candle is here? Yes, this candle went all the way down there, but then closed right there. And then this candle opened, went all the way down here, past that low again, and then closed right there. And then we opened on this candle and tore off. That to me, listen folks, listen. This is where you're supposed to be writing things down. If you write this down, okay? How do I know when to trust a fair value gap? Well, first I have to have a bias. Okay? Am I bullish or bearish? Because the narrative is going to build the idea of whether or not I'm going to be bullish or bearish. The bias cannot be derived until you at least confer with what the present narrative is. And the narrative is what I've been talking about. The market is long-term bullish. We're at all-time highs. Avoid trying to pick a top. But the body's respecting the fact that it didn't close below that low. That tells me that this was a stop raid. So what does that really answer? Well, it answers, how do you know it's going to not go through that low and keep on going? I don't know in the first candle. I want to wait and see when it closes. It closes here. Then I want to see the next candle. What does it do? Does a little movement below that, but then the body stops there. What is that? That candle's closed right there. What is that? That's a swing low. Go back and look at the videos. That's a swing low. At a time when I'm bullish, at a time of the day when it creates the low of the day, if I'm bullish, it's knocked out traders that are long that had sell stops below that. So we crossed all boxes off that this is a high probability reversal in a day that's likely to go higher. You see how all these things come together like a dovetail. It's beautiful. It's perfect symmetry. If you wake up at 8 o'clock in the morning, 7 o'clock in the morning, anytime before the opening bell at 9:30, I look at the overnight session and see what it did like this. I look at London's trading from midnight to the London Open, and my London Open kill zone is 2 o'clock in the morning to 5 o'clock in the morning, New York local time. So back to this. How do you trust fair value gaps are good for longs or shorts? Or in this case, we're bullish, and we do see the signature that we did run stops, and this candlestick closes above the low that was taken out for stops. So that right there is my first indication that that's a very high probability reversal point. But I don't need to buy it yet. I don't need to buy it yet. You don't need to buy it yet. Ego says you need to buy it there. You don't. You wait for the next candle. Does it create a swing low? Yes. What is a swing low? A swing low is a candlestick that has a low right here, right above my cursor. And then the low that takes out that liquidity below that low over here. So we have a lower low on that candlestick. And then the next candle, when it closes, has a higher low than this candle here. So what we're saying is a swing low is this. It's any swing point in price. When the price swings up and it makes some kind of a turning point and starts to move lower, the opposite would be seen here like this. That's a swing high. A swing low is that. Okay, it's 3 bars, 3 candlesticks. And the length of these, okay, this has no bearing on anything. It could look like that, or it could look like this. You just need to have 3 of them, okay? That's also part of power 3. And a swing high could look like this, where the first high of the 3 bar candles is lower than the highest one and still lower than the third candle's high. Or it could look like this. As long as there's 3 candles with a candle to the left with a lower high and a candle to the right with a lower high than the highest one, that's a swing high. It doesn't matter if this high is higher or lower than this high. It doesn't matter. You just need 3 of them to cause a turning point. So when I see that in price action, it gives me confidence to trust that was a rate on sell side below that low here. And then the highest probability trade is to wait to see if there's displacement. That means I'm letting it, or let me properly phrase this. If I had been awake, I would have allowed for this move to occur and then tried to buy something down here. But let's say I didn't get it. Say I missed it, or I walked away from my computer and I missed the ideal entry. Then I'm going to wait. I'm going to wait for this right here. I want to see it dig up into this. Remember, this is the sell side imbalance, buy side inefficiency between that candle's low and that candle's high. I want to see it run up into these extremes from here to here. I want to see how it trades there. Does it trade all the way up to and close above halfway? Halfway of what? This gap. So if we take the fib and measure that, here's 50% of it. Does it close above that? Yes. So what does that tell me algorithmically? That it's going to use this imbalance here, okay? It's going to use that as a draw on liquidity. And now I want to see it do what? Work its way back down into this gap from this candle's high and that candle's low. This gap right here, I'm only going to refer to it in terms of its consequent encroachment, which is the midpoint of that gap, the 50%. And I would use that on a lower time frame chart to see if it's going to offer me an opportunity to go long. But it's already fulfilled its role here by drawing price up. So what does it tell me at that point? It tells me that, okay, this was a stop hunt. The market does what at that point? It's going to seek inefficiencies above price. Well, it did that quickly here. Where's there other inefficiencies? Right in here. And where are the buy stops? Above that high. And it's relative equal highs, rather. So there's buy side above the market right there. Those buy stops, once these sell stops have been taken, smart money does this. It buys sell stops and sells to buy stops. You see what it did here? It went below that low, accumulated long positions with willing bodied sellers at a low price. Why? Because somebody went long here. Do I need to know how many and who it was? No. You just need to know what time it is. And they can't hide it. They cannot hide the liquidity that will be above here. They cannot hide the inefficiencies that the chart will absolutely draw attention to. You have to have a time-based chart because price moves on the basis of time first. It's time and price. Look at the low of the day. Go back and look at the day trading concepts and the concepts I talk about. 330, that's your turning point. It's the low of the day. But now we're back into this discussion right here. So this becomes my primary focus because I want to be a buyer on a day like this. All we're doing is we're studying the future probability of price delivery. Okay, that's really what we're doing here. Price shows you this displacement to the upside, and then you wait patiently for it to trade right back down into this candlestick's movement higher. The market will want to offer down close or down expansion candles, which is sell side delivery. It really means simply this. The market moved up right here, one candle. And between this candle's low and that candle's high, there has not been any movement to the downside, which would be an efficient delivery of price action. So it first started off real quick right here. So it wants to come right back down. And what that does is it affords smart money, traders that know how to use this tipping to now enter, to get long, accumulate long positions. Where would they buy? Here's the midpoint of that big up close candle. Okay, see that? We went past it, yes. But look at where the bodies are closing. Are they closing at or below that candlestick's high? No. Did we trade to that candle and through it? Yes, because we allow the wicks to do that. Remember, the wicks do the damage. So when you're using stop losses, I'm looking at where those wicks have done the damage prior to my entry or before I move my stop loss. And because I know I see damage was done here, and I know that it can overshoot this a little bit. Okay, so if I was long down here, my stop loss wouldn't be jammed up underneath these bodies, because if it was, I would have been stopped out prematurely. So the fact that these candles are closing above the high of that candle, which makes this a buy side imbalance, sell side inefficiency fair value gap, trading down to that inefficiency, and these candles bodies not closing at or below tells me that we're really going to move higher and attack at the very minimum these relative equal highs. In this range here, we want to determine how we can also scale in, because say you didn't get in down here towards the lower end, below the 50% of that gap between this candle's low and this candle's high. And now this big candle here, it creates an imbalance. And when it trades down like this, you want to be buying in that. Okay, I have students sometimes say, well, why are you buying here and down in here? Why don't you just buy one time? Well, because the market could go down just a little bit and then stop right there and go higher. It can go down to the midpoint of the gap, which is this level here, and go there and stop and go higher. Or it can go all the way down and close, or go past it a little bit like it does here. And I don't know that, but I want to secure my largest position. I'm doing my largest entry first. So if I was buying, like say for instance, I was going to do a position of 10 contracts, I would go in at 6 right here at the upper quadrant. What that does is it grades in quarters the low and the high of that buy side imbalance, sell side inefficiency. See that? So I could be buying right there at 6 contracts. I can add 2 more there and 2 more there. So I would be positioned for 10 contracts. Yes, my 6 contracts would be in a little bit drawdown when it trades to here. And then it would be in further drawdown because I add 2 more there when it drops down to here. I'm completely fine with that because my risk would be affording a move down to this candlestick's consequent encroachment. I'm at least considering it going to at least move that far. Now, why that? Why that? Because the likelihood of it coming all the way down to halfway of this wick, while it's possible, it's unlikely to do that. Why? Because we had that swing low there. So this wick went lower than this wick's low did. So this is the one that if it's going to reach into a wick or midpoint of a wick, it's going to go into that one as an extreme. And you can see we did go past it a little bit, but we didn't even get to the midpoint. If we have this here, I'm going to drop out of the 50-minute chart because everything I'm annotating here we'll be able to see on the 5-minute chart. I want you to see. Now over here on the 5-minute chart, I'll maximize it. Now look what's going on here. We drop down. Look how much work they're doing at the lower quadrant, the 25% from this candle's high to that candle's low. So there's 1, 2, 3, 4, 5 points inside of that range that I'm interested in. It's obviously the low, it's the high, and the midpoint, but there's 2 quadrants, the upper quadrant and the lower quadrant. Look how price is behaving. See what it did here? See how that overlaps with this down closed candle's high? That's an order block. It's not just a down closed candle that makes it an order block. It's the narrative that it's a bullish day. We did come down into this and close up that buy side imbalance, sell side inefficiency. And then does price support at the lower quadrant? Look what it's doing here. Is it doing it? Yes. Is it algorithmic? Absolutely. And does the market run higher there? Yes. And then it drops right back down into this buy side imbalance, sell side inefficiency, that one single candle, which is the same thing we're annotating on the 50-minute chart that's seen here in 3 5-minute candlesticks. That singular one pass higher there is a replication of this larger one just in a smaller time frame. But look what it does. It allows you to see if it trades back down into the upper quadrant, which is completely permissible, and it trades down to this candlestick's high. What is the order block? Inefficiency, bias is bullish, sell side's taken, relative equal highs is your first draw, and 15-minute buy side up here. So this would be an area where you can be a buyer too. This would be a real good area for me. If I was missing everything down here and I didn't do anything down here, I didn't do anything here, I could be buyer right there as it drops down to the upper quadrant because it's filling in that inefficiency there. And I'm anticipating and expecting price to do what? Expand to draw into the buy stops. Why? Because smart money bought the sell stops and they know time. And all we're doing is looking for opportunities for price to do what? Show its hand to us. If we're bullish, okay, then it should show us sell stops being taken out or support in areas where there's inefficiency, like we've shown on that 15-minute time frame. And when you drop down the lower time frames, all of a sudden you get more details than you never noticed before because you don't think there's an algorithm. So the market rips higher. Let's take our attention back to the 15-minute chart just for a second, okay? So we'll 15-minute time frame. We'll maximize that real quick. So we have this buy side imbalance, sell side inefficiency. It trades down into it, and then there's this gap I mentioned earlier. Okay. Now think, what is an inversion fair value gap? ICT, how do you know when you're doing your live trades and you're annotating them, you're calling it an inversion fair value gap before it even forms, before it even trades there? Right. That's authorship. Let's go into it here. So now think, okay, if I'm bullish, if I'm expecting price to go up to here, and we're only right here, and we're trading up into it, everyone else that thinks that they see this as a liquidity void or stocks being hunted and a liquidity void and we're going lower, they would see that as a short entry. Not me. What am I telling you? I'm telling you that this right here, this sell side imbalance, buy side inefficiency, where the candlestick's low, that candle right there. So this candlestick's low and this candlestick's high right here. That portion on this candle, that's what I'm highlighting. What is that? The algorithm will go right back to this time frame, right back to this range in price action. That candlestick's low and this candlestick's high. So that's what I'm highlighting there, okay? So because I'm bullish, I'm going to look at old sell side imbalance, buy side inefficiencies, or down close fair value gaps as a rock climber, okay? I'm going up. I'm trying to climb the surface of this rock surface to get to this liquidity. And maybe if I'm strong enough and hold on long enough, I might be able to get to the zenith of that high back there, like I talked about real time before I did it. If that's the case, I know that this imbalance exists. Because if this is there on the sell side delivery, part of a what? Part of what? A market that is potentially going higher, then I'm going to treat this as a foothold or a hand grabbing point as a rock climber. And I'm going to wait for it to trade up above it. My hand's going to use it to pull me up higher in my trade. And then I'm going to wait for it to, I'm going to get above it and then I'm going to trade long when it moves into this area. Why? Why should I do that? Because it's going to act as support. Because why? If it's going to go higher, it's inefficient over here because it went down on this candlestick. Inefficient delivery and repricing for that range between this candle's low and this candle's high would be seen with candlesticks that go down in that same specific range that's highlighted in orange. Once we got above it, what did it do? It traded down to the low of it. And then what happened? Oh, look at that. Some mysterious movement to the higher side. And it ran into the buy side. Did it stop there? No, it ran right to the level I told you it would reach for. I think I've already explained enough in here to justify why that's an inversion fair value gap. Inversion fair value gaps are old inefficiencies that are opposed to the trade direction you're in. When you understand this, you will understand how also my market maker models are not Wyckoff, because this right here is your unicorn. Second stage reaccumulation. Smooth consolidation. Smart money reversal. Low risk buy. Accumulation. Reaccumulation. Second stage. Whoop, whoop, whoop. Where's the biggest move? Right there. Hello. We're going to go down into the 1 minute chart. Okay, so here is the 1 minute chart. And right in here, I started off this conversation with right below these lows, there'd be what? Sell side liquidity. And the market trades down, takes that liquidity out. At a time when we're in an inversion fair value gap, at a time where it would afford me a run up into 10 handles. Okay, so if I can get 10 handles there, I don't need to have the lowest low and I don't need to have the highest high. So if I know it can likely draw up to this price point here, that's these relative equal highs. You see that right there? So if I know it can draw to that level, and I'm under these lows here, inside of a fair value gap that is now an inversion fair value gap, that's this over here in the 15-minute time frame, then I know this is a potential footing to send us higher. But is it time to make that price run there like that? No. But can I scalp it and get 10 points? Yes. And I'll explain what I meant by saying that. Just give me a second. We have the market trading below the lows here. I see the market taking out sell side. I want to be a buyer of that. But I saw price on a 1 minute chart saying, okay, I can't get the lowest low, but I'm going to try to get as much as I can because I do believe we're going to go higher, at least 10 handles. What is this separation right here between this candle's low and this candle's high? If I'm bullish, it's a fair value gap, right? What kind of fair value gap? Inversion fair value gap. So in here, we're seeing price drop down, the market runs up, and we have a down closed candle, and we have market trading down into that. So we have several factors here that are building on this potentially being a short-term turn, and then price running higher for 10 handles. So if we take a rectangle here, and you go to 750 to 810, that is the macro. See that? What did the market do? We're bullish. Where's the buy side? Here, because it stopped right where it did over here on the 15-minute time frame too. That's this candlestick right here. That candlestick's high on the 15-minute time frame is that individual 1 minute candle right there. See that? So what does it do? It drops down at 751. What is it doing? It's dropping down to take the liquidity out here on that low. To do what? To start spooling. Where? To clear the liquidity above here. Right? And what you want to do is when you're tape reading, you want to spend the majority of your time focusing on what price is doing 10 minutes before the top of the hour to 10 minutes after. Okay. What happens is the price engine that is the algorithm many times will spool. Okay. During these times, and it will run to where the stops are, or it will run to where the inefficiencies are. And what do I mean by that? Inefficiencies are gaps, whether they're up closed gaps or down closed gaps. One singular candle moving in one direction, that's an inefficiency. That's what we've been talking about and showing here. So this is the algorithmic price run. This is just a run-of-the-mill scalp. Which one would you rather be a part of? If you're trying to buy on a day like this and it's bullish and you're aiming for the levels I was outlining here when we first started our live stream, which one would you rather be a participant in? Some random price only entry versus a very specific algorithmic advantage where price will absolutely start spooling and reaching for the liquidity based on time first. But when it does this here, then we can go back into, okay, what are we looking for if we miss this move? Well, what's this low? I mean, we have a low, high, lower low. That makes this up close candle a breaker. And the market trades down here. And also, what is it doing here as it trades down into that bullish breaker there? This is not support and resistance, because support and resistance would have been, okay, well, it went above here, so it should stop there and go higher. That's how I lost money in the 90s, because I thought it was so easy that support and resistance is going to be the be all end all. And it wasn't. I lost a lot of money trying to do that stuff. And it's the entire range of the up close candle. The highest up close candle is your breaker. In this case, it's not even trading down to the low, but what is it doing in addition to that? You see this? That right there is a nesting of two PD arrays. So this is an old buy side imbalance, sell side inefficiency, fair value gap that was used right here, and it went up. But did it rally above that high here since this movement here? No, it didn't. It's consolidating. So it drops back down to it here, and you're still inside that breaker. So you have to afford, if you're trading long, your stop can't be so trailed up to get stopped out prematurely. So that's all factors of how I would measure where I would move my stop. So if I was going long down in here, if I went in and bought this immediate rebalance, which is the open trading down immediately going back to this candle's high, that is extremely strong. They are the bee's knees for entries. If you can get in, or if you're supporting your trade with a stop loss below a immediate rebalance and your targets or liquidity hasn't been traded to, the market is absolutely not going to your stop loss. And you heard exactly what I just said. That's not me exaggerating.